Let me be brutally honest with you. The government has been patiently waiting for decades while your retirement account grew, and the moment you hit a certain age, they are coming to collect. Every single dollar you stuffed into that traditional IRA or 401k was never fully yours to begin with, and Uncle Sam has a legally enforced schedule to make sure you hand over his cut, whether you need the money or not. This is not a maybe, this is not a suggestion, and this is definitely not optional. Miss the deadline, and the IRS slaps you with one of the harshest penalties in the entire tax code. So if you think you can just let that account sit there and grow forever, think again. Because required minimum distributions exist for one reason and one reason only, and that reason has nothing to do with your retirement comfort and everything to do with making sure the government finally gets paid. Here's the cold, hard truth nobody told you when you were patting yourself on the back for maxing out that IRA. The IRS never forgot about their cut, not for a single second. Required minimum distributions, or RMDs, are the government's way of saying, "Time's up, the deferral party is over." Every year, starting at a government-mandated age, you are legally required to pull a minimum amount out of your traditional IRA or 401k, whether you want to or not, whether you need the money or not. Miss it? Penalties. Think you can outsmart it by just leaving the money alone? You can't. This isn't a suggestion. It's a mandate baked into the tax code, because Uncle Sam was never giving you a free lunch. He was giving you a tab, and RMDs are when he slides the bill across the table. The sooner you understand that, the sooner you can stop being surprised and start being strategic. Let's cut straight to it. Not all retirement accounts are created equal, and the IRS absolutely knows the difference. Traditional IRAs, SEP IRAs, simple IRAs, 401ks, 403bas. If the government let you stash that money away without taxing it up front, congratulations, you've got an RMD ticking time bomb on your hands. The IRS isn't generous without a reason, and that reason is they fully intend to collect eventually. Now here's the plot twist that actually works in your favor: Roth IRAs. During your lifetime, Roth IRAs owe the IRS absolutely nothing in mandatory distributions. Zero, zilch, not a dime. That's not a loophole. That's a legitimate and powerful planning advantage that far too many people completely ignore. So, before we go any further, you need to know exactly which bucket your money is sitting in, because that single detail could be the difference between a retirement you control and one the government controls for you. So when exactly does the government start requiring these withdrawals? This is where the Secure 2.0 Act made a meaningful change. For most people, the RMD starting age is now 73. But here is where it gets even more interesting. If you were born in 1960 or later, that age bumps up to 75 once that provision takes effect. That is a significant shift from the old age of 72. Now, why does this matter if you are in your early 60s? Because it means you potentially have 10 or more years before your first required withdrawal. That runway is not just a number. It is time to do Roth conversions, manage your tax brackets, and restructure your accounts in ways that could save you tens of thousands of dollars. The earlier you understand this window, the better positioned you will be. Now that you know when RMDs kick in, let's talk about how the actual number gets calculated, because this is where it gets concrete. The IRS uses a straightforward formula. You take your account balance as of December 31st of the prior year, then divide it by a life expectancy factor pulled from the IRS Uniform Lifetime Table. That factor changes slightly each year as you age. Here's a simple example. Say you're turning 73 and your traditional IRA balance on December 31st was $500,000. The life expectancy factor for age 73 is roughly 26.5. Divide 500,000 by 26.5 and your required minimum distribution comes out to approximately $18,868 for that year. That's not optional. That money must come out, and it's fully taxable as ordinary income. Now let's talk about timing, because this is where a lot of people accidentally create a tax problem for themselves. Your very first required minimum distribution technically has a grace period. The IRS allows you to delay that first one until April 1st of the year after you turn 73. Sounds generous, right? Here's the catch. Your second RMD is still due by December 31st of that same year. So delaying means taking 2 full distributions in a single calendar year. Think about what that does to your taxable income. Both distributions stack together, potentially pushing you into a significantly higher tax bracket in one shot. That's not a loophole, that's a trap. This is exactly why most financial planners strongly recommend taking your first RMD before December 31st of the year you actually turn 73. One distribution per year keeps your income smoother and your tax bill far more manageable. Now that you understand how RMDs work and when they hit, let's talk about where people actually go wrong, because the mistakes here are expensive and entirely preventable. The single most common error is simply ignoring RMDs or missing the deadline altogether. It sounds almost too basic, but it happens more than you would think. People get busy, assume their financial institution will handle it automatically, or just don't realize the clock has started. Here's why that matters. The penalty for missing an RMD used to be a crushing 50% excise tax on the amount you failed to withdraw. Under the Secure 2.0 Act, that dropped to 25%, and even 10% if you correct the mistake quickly. That sounds like progress. But a 10 to 25% penalty on top of ordinary income tax is still a painful, completely avoidable hit to your retirement savings. Now here is the second major mistake, and it is one that trips up people with multiple retirement accounts. If you have several traditional IRAs, you do not have to take a separate RMD from each one. The IRS actually allows you to add up the total RMD amount across all your IRAs and pull the entire sum from just one account. That gives you flexibility in choosing which account to draw from based on performance or other factors. However, and this is critical, 401k plans do not follow the same rule. Each 401k must have its own RMD taken separately from that specific plan. You cannot combine them the way you can with IRAs. Mixing up these two sets of rules is surprisingly common, and getting it wrong can still trigger that 25% penalty we just talked about. Here is a mistake that flies completely under the radar: neglecting to update your beneficiary designations with RMDs in mind. Most people set their beneficiaries once and never look back. But when an account owner passes away, the RMD rules shift dramatically based on who inherits the account. A surviving spouse has options. A non-spouse beneficiary simply does not get. A trust or charity follows an entirely different set of rules. If your beneficiary designations are outdated, misaligned, or just never thoughtfully chosen, your heirs could face a compressed withdrawal timeline and a tax bill they never saw coming. This is not just an administrative detail. It is a critical piece of your overall retirement tax strategy. Review those designations now, not later. Now that you understand the mistakes to avoid, let's talk about one of the most powerful moves you can make before age 73, Roth conversions. Here's the core idea. If you're in your early to mid-60s and currently sitting in a lower tax bracket, you're in a genuinely valuable position. Before required minimum distributions kick in and force income onto your tax return, you have the opportunity to voluntarily move money from your traditional IRA into a Roth IRA. You pay the taxes now at today's lower rate, and that converted balance is permanently removed from future required minimum distribution calculations. Every dollar shifted to a Roth is one less dollar the IRS can force you to withdraw later. This pre-73 window is not just helpful, it's one of the most strategically significant periods in your entire retirement tax planning journey. Now here is where the strategy gets practical. The goal with Roth conversions is not to move everything at once. That would likely push you into a much higher bracket and create the exact tax problem you are trying to avoid. Instead, think of your current tax bracket as a container you want to fill strategically each year. Say you are 64, married filing jointly, and your taxable income sits at $80,000. The 22% bracket extends up to around $190,000. That gives you meaningful room to convert additional funds without crossing into the next bracket. Converting $30,000 to $50,000 annually over 7 to 10 years can shrink your traditional IRA balance significantly. Smaller balance at 73 means smaller required minimum distributions, which means less forced taxable income every single year going forward. Now here is another powerful strategy worth knowing about: qualified charitable distributions, or QCDs. Once you reach age 70 and a half, you can donate up to $105,000 per year directly from your IRA to a qualified charity. What makes this so valuable is that the donation counts toward your required minimum distribution for the year. So instead of taking that withdrawal as taxable income and then separately writing a check to charity, the money goes straight from your IRA to the organization. It never touches your taxable income at all. For people who are charitably inclined and do not actually need every dollar of their RMD to cover living expenses, this strategy is incredibly efficient. You are satisfying the IRS requirement while simultaneously supporting causes you care about, without the tax hit. Here is something most people never connect until it is too late. Your required minimum distribution does not just add to your taxable income. It can set off a chain reaction of financial consequences that ripple through your entire retirement picture. When your income rises because of required minimum distributions, Medicare can hit you with income-related monthly adjustment amount surcharges, meaning your Part B and Part D premiums jump significantly. At the same time, more of your Social Security benefits become taxable, up to 85% in some cases. Certain deductions tied to income thresholds can quietly disappear. None of this shows up as a warning label on your individual retirement account statements. These are invisible tripwires buried inside the tax code, and every single one of them becomes far easier to manage when you start planning before age 73. Here is a detail that surprises a lot of people who plan to work well into their 70s. If you are still employed at age 73 and actively participating in your current employer's 401k plan, you may actually be able to delay required minimum distributions from that specific plan until you fully retire. This is known as the still working exception, and it can give working individuals meaningful extra time before mandatory withdrawals begin. However, there are important boundaries here. This exception does not apply to traditional IRAs, SEP IRAs, or old 401k plans sitting with previous employers. Those accounts remain subject to standard required minimum distribution rules, regardless of your employment status. So if you have multiple retirement accounts, you cannot use this exception as a blanket shield. It only covers your active current employer plan. Now let's touch on inherited IRAs, because this is one of the most confusing areas in retirement planning right now. Before the Secure Act, beneficiaries could stretch distributions over their lifetime. That changed dramatically. Today, non-spouse beneficiaries generally must fully empty an inherited IRA within 10 years of the original owner's death. That 10-year rule sounds straightforward, but here's where it gets complicated. The IRS is still finalizing guidance on whether annual distributions are actually required within that 10-year window, or whether you can simply wait and withdraw everything in year 10. The rules remain genuinely unsettled, and getting this wrong could mean unexpected penalties. If you have inherited an IRA or expect to receive one, please do not navigate this alone. Work directly with a qualified tax advisor who specializes in inherited account rules specifically. Here is something worth sitting with for a moment. If you are 62, 63, or 64 years old right now, you have approximately 10 years before required minimum distributions begin forcing your hand. 10 years. That is not a narrow gap or a lucky coincidence. That is a full decade of opportunity sitting right in front of you. 10 years of strategic Roth conversions. 10 years of managing which bracket you land in each April. 10 years of thoughtful, intentional withdrawals designed around your life, not the IRS's schedule. The people who use this window wisely do not just save a little money, they can save tens of thousands of dollars across their retirement. That kind of outcome does not happen by accident. It happens because someone, at exactly your age, decided to pay attention and take action early. Now let's make this real for you personally. Pull up your current traditional IRA and 401k balances right now if you can. Pick a reasonable annual growth rate. Somewhere between 5 and 7% is common for long-term projections, and estimate what those accounts might look like when you hit 73. If math isn't your thing, don't worry. There are plenty of free online RMD calculators that can run this projection in just a few minutes. Simply enter your balance, your age, and an assumed growth rate, and the tool does the rest. What you'll see is your estimated first required minimum distribution amount. And here's the thing, seeing that actual dollar figure, whether it's $12,000 or $40,000 or more, has a way of making everything we've discussed suddenly feel very urgent and very real. Before we go any further, let's lock in the essentials with a fast recap. Required minimum distributions begin at age 73 for most people. They apply to traditional IRAs, SEP IRAs, simple IRAs, and most employer plans like 401ks and 403bs. Roth IRAs are off the hook during your lifetime. That is a big deal. Miss your RMD deadline, and you are looking at a 25% excise tax penalty on the amount you should have withdrawn. And that is the reduced rate after Secure 2.0. The calculation itself is straightforward. Take your December 31st account balance from the prior year, divide it by your IRS life expectancy factor, and that is your number. Simple formula, serious consequences if ignored. Here is something important before we wrap up. If you are feeling overwhelmed right now, that is completely normal. RMD planning carries real emotional weight, and many people feel like they have already missed their chance to get ahead of it. But that is simply not true. Even if you are 68 or 70 years old, there are still meaningful moves on the table. Qualified charitable distributions, strategic withdrawals, beneficiary updates. These tools do not disappear just because you are closer to 73. The window shifts, but it never fully closes. Think of it this way. The best time to start planning was 10 years ago. The second best time is right now, today, this moment. Do not let the feeling of being behind keep you frozen. Paralysis is the only move that guarantees a worse outcome. Action, even imperfect action, always beats waiting. Here is your action step for today. Pull up your traditional IRA or 401k balance right now and run a quick RMD projection using any free online calculator. Just seeing that number can completely change how seriously you take this planning window. And look, I want to be straight with you here. Do not take retirement tax advice from a cartoon on social media, a 60-second video with a dancing character, or anyone who has never actually sat across from a retiree facing a massive, unexpected tax bill. This stuff is real, it is complicated, and the stakes are your financial security. If you found this video helpful, subscribe because we cover retirement tax planning strategies every week in plain language that actually makes sense. And if you want to go deeper on Roth conversions specifically, we have a full video on that linked right here. Now here is the final thought I want to leave you with. The people who retire with the least tax stress are not the ones who earned the most. They are the ones who planned the earliest, and they got their information from credible sources. Start today and start smart.